Okay, good morning and welcome 2016. Happy New Year. And I hope you have a better year than equity markets have begun this new 12-month period, because we've got a bit of carnage here on the get-go. I'm just looking at some of the equity moves. So you look at my top two charts here, the S&P on the left and the DAX on the right. I mean, it doesn't seem too dramatic, other than we do have very large red candles, but we actually have had the DAX. It's bouncing a touch now, but briefly below 4%. So that's more than a 4% drop here as we get the year off and running. A big gap open and then more downside. Key break below 10,400. Of course, US equities following. I'll come and talk a bit about this shortly. I mean, it's certainly led by China with, there's plenty of stats that will fly around on this, but it is officially the worst first day of the year for Chinese equities ever in history. They've been stopped 7% down. Their new circuit breaker, literally on day one, being tested and working, at least, in that the market did get stopped at 7%. But I'll come and talk about that in a sec. But certainly this big downside here at the beginning of the year is driven by Chinese equities having a shocking day. We'll come back to that. But yeah, let's just kind of begin by just looking back. I mean, we've obviously closed out 2015 here. You just look on this S&P chart, look on a yearly time frame. Now, most of you will have been out of action for the last couple of weeks, since before Christmas. So let's just get a quick update on what's been happening over those 2 weeks before we look at what's right in front of us, what's happened over the weekend, what's happened overnight, and what have we got happening this week, and how do we think things are going to shape up, because it is a big week actually for data, as it always is. The first week of each month tends to carry the most important macro news flow, so a busy week ahead. But let's just look at this yearly chart for the S&P 500 here, because we do have a down year, of course. The S&P 500 futures closing down minus 0.83%, so hardly anything, but it is a red candle, and so that does put it at the first down year since 2008. So 6 years up in a row. Obviously, this 2011 one was a doji. But yeah, a down year, and of course, we've got a yearly candle for 2016 here, because of course this is just for today. And as it stands, we are down, and Bill's been throwing around some stats this morning. And over the last 30 years, here's a stat for you. Over the last 30 years, every time day one of the year has been negative, all but two of those years have ended in negative years. There you go. There's a stat for you. Every time we've had a day one of the year down, on all but two occasions, the year has finished down. These stats are, I think, a bit of a nonsense. Sorry, Bill. Whether we have a down year or not, I would say has virtually nothing to do with what happens on day one of that year. We've got a hell of a lot of stuff ahead of us, and that's what's going to shape up the performance for this year. But, I would say, as here we are day one, I would not be surprised if we have a very similar year to last year for the S&P, i.e. we get some ups, we get some downs, obviously, but by and large, we'll probably fetch up where we started. I don't see much movement in the end for this index for 2016. I don't carry much positive expectation for this market. Whether I carry much negative expectation, I guess remains to be seen. But again, I don't carry that much negative expectation either, to be honest. I'm pretty neutral on US equities, with plenty of risks, positives and negatives, obviously, on the horizon. But for now, again, I don't expect too much out of this index for 2016. But let's look at let's look at 2015 as a whole. I'm going to bring in a chart here from Deutsche Bank. It has to be said, 2015 was a pretty bad year for financial assets generally. I mean, a pretty bad doesn't even cover it. It was a terrible year. But to be honest, this is looking at over 40 different assets here, 40 different markets, I should say, sorry, with all the major asset classes covered. You've got equities, you've got bonds, you've got commodities in here, you've got FX. And check out how many of them, sorry, this is just for December, this chart here, sorry. Firstly, we're looking at December. Actually, I don't want to look at December first. I want to look at the year as a whole. Let me go down. One sec. Okay, here's 2015. Firstly, in local currency terms, okay, and I'll come on to the dollar terms in a second. Local currency terms, you've got the likes of Russia and Portugal and Italy, and well, you got Chinese stocks here as well as one of the best performers of the year. I mean, that doesn't really cover it, but certainly Russia and the couple of the peripheral European indexes outperforming. Obviously, on the flip side, you're getting the oil markets coupled with the more general commodity markets, with the likes of Greece and the emerging markets and Brazil, you know, the basket cases for 2015. But once you take out the local currency and bring in the dollar, I mean, this is what I meant by a shocking year. Out of 43 different markets here, only 9 finished in positive territory. And the best, which is the Nikkei 225, actually only up 10%. The rest got killed. I mean, look how many markets finished 10% down or worse, of course, with the oils and the Brazils. But as financial years go, this has to be right up there with one of the worst years for traders, for hedge funds, you know, trying to position themselves in markets for generating return. Well, there wasn't any. So, I mean, we can't get a year as bad as this again. I mean, across the asset spectrum. I mean, it's ironic that really the best place last year was cash. It's ironic given that interest rates are at 0, and yet really the best place to be was cash, in that at least you were protected, and inflation wasn't eroding that value away. So bad year. Okay, so let's kind of just put that to bed. I think a lot of people are very pleased to just get 2015, just get that tucked away into the drawer, and we can start afresh for 2016. A lot of hedge funds out there will be very, very pleased to get that year behind us, and they can start again with a fresh slate. So, bad year. Let's have a look at what's happened over the last couple of weeks since Christmas, as we've gone through the kind of New Year period. Again, it's been pretty choppy. If we just, let's go to like a 4-hour chart for the S&P, just to look at that period in a bit more detail. We kind of generally close things up on the 18th, where we finished right on the back foot with a pretty decent sell-off on the kind of final full week before the festive period kind of started to get in the way, and we almost drove down to test the mid-December low. But then actually we got a pretty positive move into Christmas. We then got a positive move after Christmas, but that's been all unwound with a negative day on the 30th of December, a big 1% sell-off on the 31st of December, and already a 1.5% sell-off today, first day of 2016. So what happened the back end of last week? Well, on the data front, you know, you got things like the kind of notable data point, I would say, that sort of grabbed the headlines was the Chicago PMI number from the US. Here we go. This was announced last week, and this came in spectacularly badly. The worst number since 2008, I think it was. Hang on, let me get that right. July 2009, sorry. Lowest reading since July 2009. 42.9 was the reading. So if we just go to a 10-year chart, you can see you've got to go back to 2009 here, back into the very heart of the crisis to find the last time this lead indicator was this bad. And you can see we've got a general downward trend for the last sort of 4 or 5 years that's been confirmed with this break. Maybe some seasonal factors in here, perhaps responsible, but certainly this is what set up that negative run. The last couple of days of 2015 were notably bad, and as I said, we've added to that significantly this morning. So the Chicago PMI number was bad. We got a couple of other things then of note. If we just looked at, if we just look at crude oil, we actually had a pretty decent bounce because we mid-December was the low. If we're looking at the continuation chart here for WTI crude, then 18th of December was the low at 34.29. We had a big bounce then, the week, Christmas week, if you like. We did have a big bounce, and in fact, this was one of the best weeks to the upside for crude oil ever. More than a 10% rally, even though it doesn't look much on this chart, it must be said. And you would say we are still in a downward trend technically. Let me just draw a line on this. Downward trend line, I guess, well, technically, are we? Maybe we look like we're kind of, it's tough to know where to draw this trend line. I'm only just throwing that on there quickly, but perhaps we are looking to break the downward trend with this little movement we've had today, actually, even though we're now down on the session. What's important is we tested that 24th of December high at 38.28, and that's where it's failed, and we've had a pretty sharp reversal off that. Any movement above 38.28 would set up a test of $40, and then that's big. That's huge. I think the $40 handle for WTI crude is the big price point for January. And if we can get our heads above that, then that really does start to lock in the idea that the downward trend seen in Q4 of 2015 is over. Whether we flatten then, maybe. I think we stabilize rather than necessarily driving back up to $50. We'll have to be patient for that, I would say. But I'd say $40. Our main theme, or maybe not my main theme for this year, and certainly for the first part of this year, is to see one of the big stories of 2015 come to an end, and that is the commodity market collapse. The oil led, the dollar strength led, the weak demand side led commodity market collapse. I think this has gone too far, and I think we'll see that stabilize, and I think that will be the big driver for across the asset space movement for Q1 of 2016. Now, for this to happen, we're going to need oil above $40. Fairly soon. Over the next couple of weeks, you're going to need to see oil above $40. It may happen even sooner than that. We've got ongoing geopolitical risk that's kind of escalated further. I'm sure you've been reading up on the Saudi-Iranian sort of negative diplomatic developments. We've had Saudi going ahead with 47 executions over the weekend. This is 47 people being killed as part of the death penalty that they were sentenced with. A lot of these executions, I should say, actually goes back 10 years to some of the terrorist plots in Saudi Arabia, and a lot of these individuals getting executed were convicted of involvement in that terrorist plots that go back over a decade. But there's one Shia cleric in particular that was executed over the weekend that's really flared up tensions between Iran and Saudi Arabia. The Saudi embassy in Iran got stormed and set on fire in protest. You've now had Saudi Arabia, what looks to be officially severing diplomatic ties. So look, these two neighbors don't get on anyway, but we've definitely had a pretty significant step up in the tensions between the two. So this needs to be monitored, obviously, from these are certainly Saudi, of course, one of the biggest, or the second biggest, I guess, oil producer in the world at the moment, just behind Russia, and then Iran looking to come back to the table forcefully in terms of oil production if we get these sanctions lifted at some point, probably towards the end of Q1, US and international sanctions being lifted, allowing Iran to pump more oil. This should bring at least 500,000 barrels more, if not up to 1 million barrels more to the market, a market that's already, of course, massively oversupplied. So we'll see. This certainly carries a risk to supply. It's not a risk that's translated into supply risk being priced in yet. I mean, oil's at $37. This is spectacularly low, this price, and we're not really seeing any supply risk priced in yet, but it's something to monitor. Of course, we've still got the Syria crisis ongoing, and more sort of Western involvement in Syria. And so this needs to be monitored very closely, of course. So we go into 2016 with certainly geopolitical risk towards the top of the agenda, and this can play a role in helping push oil back above $40. We'll see. So that's one thing to look out for. The other big thing of the weekend then, of course, and really of today, is China. Chinese stocks stopped limit down at 7%. Now, at the end of last year, at the end of 2015, China put in place some measures to protect their markets against savage downside. This kind of goes back to the events in the summer of 2015, where we got spectacular downside on certain days. 12%. I think one of the big days, Black Monday, was when the Chinese markets dropped 12% in one session. So they put in place some breakers, some circuit breakers. The way it works, and today is the official start of these circuit breakers. So it's actually literally day one, and they've been tested. What happens is if the market drops 5% intraday, then we get a 15-minute break. Okay, markets shut for 15 minutes, they then reopen. If the markets then go on to sell off and hit minus 7% for the session, that's it. No more trading that day. They're closed, limit down, they'll reopen the next day. So the very first day these circuit breakers are officially in action, they get tested. Now, people have been pointing towards the manufacturing data that was announced from China overnight, which was bad. But it wasn't that bad. I mean, it was worse than expected. And sure, it's the sixth reading. Well, actually, no, more than that. Hang on. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th reading in a row below 50. And it was slightly worse than expected. But, it's not as bad as we got back in the summer last year. So this data, I think, was the trigger point. But I don't think that it's because of this data that the market dropped 7%. That's not true. I just think, actually, a sort of perverse human nature, these circuit breakers are now in place. Well, let's see if they work. And I think it just triggered. Plus, I think a bigger issue is we had some of the blackout period back in the summer where we got violent movement to the downside. There were some bans put in place on certain people, certain market participants were prevented from selling any more equities. Those bans came to an end at the end of 2015. So here we are at the start of 2016, and it looks like what's really driven this market to the downside is people selling equities now that they're able to again, having not been able to since the summer of 2015. This then, of course, also meant that we got a key test of this circuit breaker on its first day of operation. So this is set up what you're seeing on your screens, which is heavy downside across markets this morning. We're beginning to see a stabilization. If we just zoom in a bit now on a 1-hour chart across these assets, then we've had Europe make that key break. We've broken down below last week's lows, so the 22nd of December lows. So for the DAX at 10,400, we've just had the S&P 500 test the 2,000 handle. What we're getting is certainly a risk off here, obviously, and what we're seeing in this risk off is not dollar strength, but actually, if anything, dollar weakness. The yen and the euro, here are your sort of safe haven currencies. And you're getting decent upside for the yen, decent upside for the euro, and then therefore at the expense of the dollar. So actually the dollar's weak here, even sterling's up against the dollar. So you're getting equities down, you're getting the dollar under pressure, you're getting safe haven bonds sharply higher, and oil was mixed, but now certainly oil's come under pressure now also as it drops down to test the $37 handle. So this is what's shaping the sentiment, very negative sentiment beginning to the year. Let's have a look quickly. We've got some data coming very shortly actually, so I'm going to probably get off the mic ASAP, but let me just test this. And we'll perhaps talk about the week ahead a little bit later on. Just want to get off the mic before this German manufacturing data, which is about to hit the wires. We're expecting it to be 53. These are final readings, don't forget. Actually, I'm probably a bit late. Let me just, I'll broadcast this live. So we've got this German data that's about to be announced. Let me just give you a time check.
53 spot 2.
There we go, 53 spot 2, so marginally above expectation. 53 spot 2 for German manufacturing PMI. Let me just show you the chart. This means an edge above the reading we got, the preliminary reading for December that we got 3 weeks ago. So this bar here will get revised up to 53.2, which does make it, well, I guess that's the second best reading we've had in over 12 months. You've only got this August reading that was up at 53.3. That's the only one better. And this does indicate what we've seen over the last few months, which is nice and solid European data, it has to be said. We've been getting a real improvement, particularly on Eurozone PMIs, and certainly on the manufacturing side. So here we've got some decent data from Germany, which might help stabilize the sentiment, which has been heavily negative this morning. We're going to get the Eurozone reading as well in about 4 minutes' time. But do remember, these are the final readings for December. We already had the preliminary numbers, which tend to be more market sensitive. We had those about 3 weeks ago. So 53.1 is expected for the Eurozone. Just while I'm on this topic, if I just bring in a little chart here, and we look at global manufacturing PMIs, then what we can see, I mean, just on the top chart, you're getting, sorry, hang on, let's update. Okay, on the top chart here, you're getting global PMIs 3-month averages, okay? And what you've got, this is for the whole world, and you've got the manufacturing just edging back higher, but it's still very much in a negative trend. So what we saw sort of back end, second half of 2015 was definitely a deterioration in manufacturing PMIs for emerging markets, including China, particularly. Also for the US, actually, it was only really Europe that went the other way. If you go back, if you go to the bottom chart here, then you can see that basically on the x-axis you've got the 3-month average, and on the y-axis you've got the latest single reading. Okay, so if you're above the dashed line, then that means your last reading was better than your 3-month average. So everyone's above the line apart from Russia and Spain. If you're left of the y-axis, then of course you're in negative territory, you're in contractionary conditions, and that was reconfirmed with China's data overnight. But Europe is definitely nice and solid in that it's been on an improving trend. And the data we've just got and the data we'll get in a few minutes from the Eurozone as a whole will continue to point towards that theme. Let's just quickly look at the rest of the session, because we have UK manufacturing data coming at 9:30. We're expecting 53, a slight beat on the preliminary number. Then we get into the afternoon, we get some, well, actually, also this morning we're getting German inflation data. So this is regional inflation numbers. So Saxony reported at 8 a.m. and they delivered a 0.2% inflation annualized. That's year on year CPI 0.2%, which was actually lower than the 0.4% we got in November. But I would say that given where we are with the ECB, these inflationary numbers from Europe, for now, are less important, less market sensitive. Into the afternoon, manufacturing data out of the US. It's all about manufacturing today, as it always is on the first day of the month. But if I just quickly mention what we got coming up this week, it's a big week. I guess the main events will be Wednesday, where we get the Fed minutes, the FOMC minutes from their meeting where they raised interest rates for the first time since 2006. The key thing about these minutes on Wednesday, can we get more information about when hike number 2 is going to be? That's it. All right, that's the single important thing about Wednesday's FOMC minutes. Is there more information in those minutes that guides us as to the trajectory of the rate hiking cycle? Okay, that could be very important. We get ADP employment on Thursday, followed by, of course, the big one, which is non-farm payrolls on Friday. We get all the ISM manufacturing data as well. So it's definitely a big week with, I'd say, the two big events being the FOMC minutes on Wednesday and the payrolls number on Friday. But we'll do more of a detailed review of the week ahead as we go through today's session. But just for now, let's leave it there. We've got negative sentiment in the market, driven by a bit of geopolitical tension in the Middle East, but mainly about China's stock market collapse, which I think may be a bit of I don't think this necessarily is the beginning of another big rout in Chinese stocks. I think it is because we've had the expiration of this blackout period for certain market participants in China. They haven't been able to sell equities since the summer. Now they can, and they have. And we've got these circuit breakers in place that have been tested and actually did their job. So I think maybe you might get a stabilization now. I think you've probably seen the worst of the session already. I think this German data and the manufacturing numbers from Europe more generally will help to just stabilize things. 10,400 is important for the DAX. We've just gone back to retest it. If you get the DAX back above 10,400, things will settle down. Okay. Check out the Bund, the 159 handle is key. We almost tested it there on the risk off this morning, but didn't quite make it. The euro dollar also tested key resistance from the end of last week at 109.62. That held, and we've pulled back. And crude oil, down around an area of support just below the $37 handle. Okay. So next data, we just had the Eurozone manufacturing number, incidentally, which came in pretty much as expected, 53.2. And so next data is the UK number at 9:30. But that's it for the briefing for now, guys. And, welcome, Happy New Year, and enjoy the session.